Welcome to The Explainer. You've probably seen the headlines. Gold is hitting all-time highs. Now, the media will tell you it's because interest rate cuts are coming. But what if that's not the real story? What if the real reason is something much, much bigger? Today, we're diving into a theory that suggests the real story has everything to do with the US dollar and a potential shift in our entire financial system.
So, let's get right into it. Why is the price of gold truly skyrocketing? Is this just a temporary blip on the radar, or could it be a serious warning sign, especially for your retirement savings? We're going to look at two very different stories.
All right, so the story you'll hear almost everywhere, on the news, in the papers, is pretty straightforward. Gold is going up because everyone expects the Federal Reserve to start cutting interest rates. Simple as that.
But here's where it gets interesting. The analysis we're looking at today puts forward a pretty bold claim that this popular explanation completely falls apart when you actually look at the data from the past. So let's dig in and see what they mean.
Okay, first things first, let's really unpack that official story. It's important to understand the conventional wisdom before we start to question it.
So the logic goes a little something like this. When the Fed cuts interest rates, the return you get on things like government bonds goes down, which makes them less appealing. Lower rates can also be a sign that the economy is slowing down. And when investors get nervous, they tend to run for cover to so-called safe haven assets, and gold is the classic example.
And you see this idea reflected everywhere. Headlines just like this one are all over the place, drawing a straight line from the idea of future rate cuts to the price of gold today. This is the official narrative.
But this is exactly where the analysis we're examining starts to poke some holes in the story. It suggests that if you look at what's happened before, a very different picture starts to emerge.
Let's travel back in time for a moment. This timeline points to two other times when the Fed cut interest rates, and they did it aggressively. You can see it here, back in 2000 and then again in 2007. Rates took a complete nosedive.
Now here is the million-dollar question. What happened to the price of gold back then? Well, after those huge rate cuts in 2000, gold's price barely budged. In 2007, it went up by about $100. Now compare that to right now. Rates have changed much more slowly, but gold has exploded by nearly $2,000. See? It just doesn't quite add up.
And this right here really puts it all into perspective. In the past, you had sharp rate cuts and only modest gains for gold. Today, you have slow rate changes and a massive surge in gold's price. The two stories are basically the complete opposite of each other, which really suggests that something else, something bigger, must be at play.
Which, of course, leads us to the big question. If the story we're being told doesn't really fit the facts, then what is the alternative? What is the real driver behind this incredible rally in gold?
Well, according to the source material we're looking at, the answer has nothing to do with interest rates. Instead, it's about something far more fundamental, something at the very core of our financial system, the enormous size of the U.S. national debt.
The theory hinges on this number, $38.5 trillion. According to the data cited in our source, that's the U.S. national debt. And the argument isn't just that this number is big, it's that it's become completely unsustainable. So what does a debt that large actually cost us? Well, the source points out that we are now paying roughly $1 trillion every single year just in interest payments. Not paying down the debt, mind you, just paying the interest on it.
To really wrap your head around that number, this analysis shows something pretty startling. That annual interest payment is now bigger than the entire U.S. defense budget.
Thinking about that staggering number is really the key to this whole theory, because it leads to what's described as a very dangerous cycle. And by the way, if you're finding our videos helpful, please take a moment to like, share, and subscribe so you don't miss out on any of our future updates.
The source actually has a name for this cycle. They call it the debt doom loop. Here's how it works. To pay that massive interest bill, the government has to borrow more money. But that new borrowing just gets added to the total debt, which of course makes the next interest payment even bigger. It's a cycle that just feeds on itself and gets faster and faster.
And this accelerating debt problem, the source claims, is the real reason gold is soaring. It's pushing the entire world towards something it calls a global monetary reset. Now, to understand what that means, we need to quickly touch on the definition of a fiat currency. It's basically money, like the US dollar, that isn't backed by a physical thing like gold. Its value really comes from the full faith and credit, the trust we have in the government that issues it.
And this analysis points out that if you look through history, you see the same pattern play out over and over again.
Governments overspend, they print more money to pay the bills, and that leads to inflation. Sometimes it even leads to hyperinflation. Eventually, the currency gets devalued, and the savings of everyone holding that currency are essentially wiped out.
So let's bring this all back home. Why does any of this matter to you, especially if you have savings you're counting on for retirement? What's the real-world takeaway from this whole argument?
Well, here's the bottom line. According to this theory, the purchasing power of your dollars is at risk because of this debt cycle. And it's not just individuals who are getting worried. The source points out that central banks all around the world are buying up physical gold at record rates. From this perspective, owning a physical asset like gold isn't about speculation. It's about having an insurance policy. It's about protecting your wealth outside of a system that it believes is on very shaky ground.
And that leaves us with one final and really crucial question. Whether you believe the official story about interest rates or this alternative theory about a debt crisis, one thing is becoming very clear. Our whole idea of what makes an asset safe is being challenged. In a world with this much debt and uncertainty, we all have to ask ourselves, what does it really mean to protect what we've worked so hard for?